This is a video on finding stocks that multiply your wealth by 100 times. Any investor who finds and holds on to even a couple of such multi-baggers in their portfolio is likely to become wealthy, immensely wealthy in fact. But is this extraordinary result even possible for ordinary investors? In this video, I argue that it is, provided that ordinary investors get three things right. The first is the right temperament to spot and hold onto multi-bagger stocks for long periods. The second is to identify the criteria for picking these stocks and using them to create a basket of such stocks. The final criteria is perhaps the easiest but rarely followed. It is to keep checking if the source of returns of this basket remains intact. If you get these three things right, then the chance of creating life-changing wealth multiply manyfold, and you will be well on your way to finding and, more importantly, benefiting from 100 baggers. This video is inspired by the book 100 Baggers, Stock That Return 100 to 1 and How to Find Them by Christopher Meyer, and I recommend that you watch right till the end for valuable inputs on how to find 100 baggers.
In this video, we are going to cover the criteria for selecting 100 bagger stocks. Once you have understood this thoroughly, we shall cover the right skill sets you need to inculcate to find such stocks in our next video. In his book, Meyer lists the following criteria for selecting stocks that can turn out to be 100 baggers.
The first criteria is that the stock should be a small cap company. This is logical, as companies of the size of HDFC Bank or Asian Paints are unlikely to grow 100 times due to their very size. For instance, HDFC Bank's market cap is $110 billion. So if this market cap was to grow 100 times, its market cap would be a staggering $11 trillion. That would be 3 times the size of India's GDP. Since this is quite unlikely to happen, investors who would like to pick multi-baggers should concentrate their attention on small and mid-cap companies instead. The next criteria is the twin engines of compounding. So, Christopher Meyer talks of the twin engines in this book. If you recollect, we have spoken about the 3 sources of returns in this video. Well, the twin engines are 2 of the 3 sources we have covered. So, Christopher Meyer talks of sales and profit growth as the first engine and the PE re-rating as the other one. What Meyer is trying to tell us is that it is very difficult to get a 100 bagger with only one engine firing. So, in short, the investor needs to find stocks where not only the earnings are growing rapidly, but also where the multiples are reasonably cheap. This way, the investor can get the benefit of both the earnings growth and the multiple expansion. The third criteria in Meyer's book is probably the most important: great management. According to Meyer, the most important criteria is having a great owner-operator who is an excellent steward of the company's capital. Meyer prefers owner-operators rather than professional operators, as he feels that having skin in the game makes these type of operators take much more prudent decisions. He also prefers managements that are great executioners and detail-oriented. He believes these type of managers are continuously finding growth opportunities by making small changes in the business. Finally, the rarest quality which these operators have is that of prudent capital allocation. This quality ensures that they always find the most profitable use of the company's capital.
The fourth and fifth criteria in Meyer's book relates to investor attributes rather than any characteristic of the company concerned. The fourth criteria relates to coffee can investing. Coffee can investing is an investing style where investors hold their stocks for decades rather than years. This kind of investing is only suitable for buying high-quality companies with a durable moat. Most investors who find multi-bagger stocks tend to sell them too soon. So the fourth criteria emphasizes on investor patience so that they can benefit from 100 baggers. Coffee can investing is a necessary tool for investors who want to profit from 100 baggers, as the typical holding period of a 100 bagger is 26 years. This translates to a return of roughly 18% per year.
Myers advises investors to ignore macro events and news. The fifth criteria, again, like the fourth one, is not a criteria for selecting companies, but an attitude that investors need to have. Myers points out that the management of these 100-bagger companies do not care about the Fed raising rates or a recession in China. He says they go about their business by creating demand for whatever product or service they sell. In the same manner, Meyer suggests we should focus on finding and holding on to multi-baggers.
Having covered the important pointers Myers mentions in his book, 100 Baggers, we shall next go a bit deeper into the investor attributes that allow investors to buy and hold on to these multi-baggers in our next video.